Thanks so much, Tim. Looking forward to presenting. Okay, thank you for that kind introduction. We might just flick on to the first page if we can. So in terms of the first half FY22, I'm pleased to present some pretty great results. This is off the back of a strong FY21 where our underlying EBITDA last year was up 21%. So we've followed that momentum into the first half of FY22. Our underlying EBITDA is up 20% to $3.4 million. Revenue has continued to grow. That was up 14% to $12.2 million for the half. And our reported earnings per share was also up 14% to 0.66 cents per share. We've continued our momentum of increasing our dividends. So our dividend is actually up 67% versus the previous corresponding period to 0.5 cents per share. Margins continue to improve. They're now at 28% in terms of an operating margin, and our cash flow has improved again, only albeit marginally, but it has also continued to improve. We've also had a focus on reducing our debt, which is now 0.9 times underlying EBITDA, but it was down 11% to $6.3 million. And that's down from around about 10.1 million a couple of years ago. So absolutely heading in the right direction. Next slide, please. Some other important things in terms of the half year just gone. We've been very conscious of how the work-life balance has been shifting for our staff. So we've actually reduced our office footprint. We are in Melbourne, Sydney and Brisbane. Our Melbourne office is our biggest office. So we actually reduced our Melbourne office footprint by about half. That's going to improve cash flow by around about $300,000 a year. But it's also recognising the fact that the majority of the team will want to be in the office around about 3 days a week. We've also had in place a capital management plan, which includes a buyback, and we've actually started buying back our own stock, and we've spent, as at today, around about $300,000 buying back our own stock. Next slide, please. So Tim was kind enough to highlight what it is that we do, but I'll give you a little bit more detail here. So we operate across Melbourne, Sydney and Brisbane, as I said before. We are an accounting, wealth, capital business. We do focus on business owners, family groups and professionals and executives as our key clients that we work with. But we very much focus on trying to empower them to achieve their aspirations. But it's not just about what they want to achieve in terms of their business, but in fact our team. We have a team of 110 people that work diligently to obviously deliver service and advice to our clients. But where we really differentiate is how we interact with our clients. The way we try to surround our clients with a group of services and make sure that all of our professionals are talking constantly about ensuring that our clients get everything they need to achieve their outcomes and their goals. We have a centralised operating structure that we run for the business that allows us to keep our costs in check, and that is for IT, finance, HR and marketing. And we actually have a growing team that are in the Philippines, which also assists us to scale our business, which we have grand aspirations for over the course of the next 2 to 3 years. On to the next slide, please. This is an important slide. So as Tim said, we've got about a $36 million market cap. We're currently trading at about 10 times EPS, which is 1.73 cents per share. That's when you combine the second half last year and the first half this year to give you a bit of an idea in terms of run rate. We are paying a strong dividend. We're paying a 5% fully franked dividend at 0.9 cents per share. And that dividend is increasing, and the shape of that has been very strong over the last 2 to 3 years. The companies that we compare ourselves with are often quite a bit bigger than what we currently are now and trade at slightly higher, or if not quite higher multiples than what we're trading at. But the one that we focus on comparing ourselves most to is Kelly Partners, which is almost $250 million, is trading at a far higher multiple than what we are. The business is in good shape because we've got a dedicated team of people that actually own part of the future that we're trying to create. So we have 44% of our team own part of our business, which I think is a really important way for us to differentiate and make sure that we get the best talent to give the best advice to our clients. Over the slide, please. I've touched on a lot of these things, so I won't spend a lot more time here, but I'll just reinforce the fact that revenue is up 14% for the period versus the previous EBITDA, underlying EBITDA was $3.4 million, up 20%. Our diluted EPS was up 14%. It would have actually been up quite a little bit higher if it wasn't for an adjustment on the balance sheet due to the fact that we sublet some of our office space. The dividend is up 60% for the final that we paid on the 1st of October 2021. And the interim dividend was up 67% at 0.5 cents per share. That is being paid on the 1st of April. Next slide, please. In terms of our revenue and how our business is broken up, as I mentioned before, we have 4 key divisions within our business: accounting, wealth, capital, and SMSF, administration and advice. But 81% of our revenue is generated under the Prime brand, but we also joint venture with accountants that want to offer some of what we currently offer to our clients. And that's typically for wealth management, and that also makes up 19% of our revenue to bridge that 100%. Importantly, our business has a very strong profile around recurring revenue and existing customers returning to us every year. So 80% of our revenue is generated on a recurring basis from those continuing customers. And importantly, we've really been able to get our revenue moving in the right direction over the last 2 periods, so second half last year and first half this year. So that's now averaging around about 12 to 13%, whereas in the previous periods it was 3 to 4%. So we're heading in an encouraging direction, and one that I think supports our goal to scale our business. When you look at the shape of our revenue between what are 2 segments, so we combine the accounting and the capital division, that makes up 57% of our total revenue. 43% of our revenue is wealth management and SMSF, with our SMSF and wealth division really starting to grow quite strongly now in what is a great market for that particular division. So that revenue is up 22% versus the previous corresponding period, and we have high aspirations for that to continue in a very strong fashion. Our accounting, business advisory, and capital division again was up 9%, and we see that growing at double digits as well into the future. Next slide, please. We've been very focused in terms of our cost structure over the last 2 to 3 years, and if you look at this here, you'll see it's substantially within a reasonable range. The FY22 first half expenses look a little bit higher, but when you take out that lease adjustment for $500,000 at our expense line, they're again pretty consistent. Encouragingly, with revenue growth, cost control, we've been able to drive our underlying EBITDA up over the last 4 years. That's increased from 2.1 million to 3.4 million on a comparable basis. And as I said before, that was up 20% versus the previous corresponding period. Next slide, please. Operating margins overall have moved from 19% to 28% over that same period of time, and our operating cash flow is very strong. Almost all of what we earn turns into cash, which is important and has allowed us to reduce our debt, which you'll see there on the bottom left-hand side, but importantly also pay out a really strong dividend to our shareholders. Next slide, please. This dividend shape, as you probably picked up from this presentation, we're pretty encouraged by. We target to pay out 40 to 60% of our reported and maintainable earnings, and we're doing that now. We're paying out around about 61% at the moment. But since our AGM last year, and the 26th of November, we gave guidance. If you look at that yellow box at the very right-hand side at the bottom there, we gave guidance that our final dividend for FY22 would likely be 0.5. That's what we were talking about at the November AGM. We're now really comfortable to say that that forecast is actually going to increase to 0.6, which is really starting to reward the shareholders for the hard yards that the team have been doing to grow our business. Next slide, please. Obviously, an important part of what we do as a firm, as a public listed firm, is trying to generate the most amount of profit, but importantly in the most ethical way, and giving back to our community. So the way that we have been scored by our clients through that typical net promoter score approach has been really encouraging. And obviously the community has been through a difficult environment over the last couple of years with COVID. But it's been good to see that the services and the advice that we've been providing to our clients has been valued. That's seen our net promoter score increase by 34%. And that really is a good indicator that clients that we deal with on a daily basis are willing to promote us or recommend us to friends and family. So we're very proud about that. Giving back to the community is also very important in terms of part of what we are doing as a firm. So we do that through supporting things like Oz Harvest, but also our staff having free time to go and give back to what they're passionate about themselves. Next slide, please. In terms of our strategic plan, so as a firm, we turn over between $24 and $26 million a year. We'd like to double that over the course of the next 3 to 5 years. But our purpose at the end of the day is making sure that we are empowering people to achieve their aspirations. We want to deal with clients that would like to grow their business, their wealth, and we want to support them in a very connected manner. That's our one connected team and service approach. We'll grow our underlying EBITDA over that period by continuing to maintain strong margins. We'll look at inorganic and organic growth. A lot of what we're doing at the moment now is organic growth, but as we scale the firm, we'll continue to look at further inorganic or tuck-in acquisitions, or people that have revenue or complementary services that would fit well within our firm. Technology is a big part of what we do. We report very openly and very clearly on what we're trying to do within the firm and make sure our team are empowered with the knowledge to drive forward the strategies for our clients. So growth for us will be about inorganic, organic, and driving additional services for our existing clients. Next slide, please. In terms of outlook, we're expecting for the year to increase our underlying EBITDA again by between 5 to 10% plus. We're going to accelerate our revenue growth. That should be between 10 and 15%. We'll continue to explore those growth opportunities, as I've already mentioned. The dividend will continue to increase. And on our final slide, I'll round it out before I throw back to Tim. Just one more slide, please. Thank you. We'll continue to reduce our debt. The buyback will continue, particularly as the share price is below what we consider fair value. And we'll continue to empower our team to own more of the business and to grow the purse for everyone. Thanks, Tim.
Thanks, Simon. Good to have you back. I noticed you didn't mention the word financial advice. Is that within the wealth management component? Where does financial advice sit within your model?
Yeah, financial advice is probably a primary consideration of what we're doing. It makes up around about 30 to 40% of our revenue. It's actually where the business was founded as a financial advice business. So we broadly put that under wealth management. And really, financial advice has been a very interesting consideration over the last 3 to 4 years. The number of financial advisors in this country has reduced significantly as things have changed and requirements have increased in terms of education, etc. And that audience, or those participants, have dropped from probably 25,000 advisors nationally to 17,000. And that means that there is still the same need for clients to get advice, and that presents a material opportunity. And you're starting to see that flow through as part of that financial advice and SMSF segment, which grew by 22%.
And I mean, financial advice on its own is generally quite a low margin business, but you've got decent margins here of kind of 27%. So where does your margin, that high margin, come from within the business?
Yeah, so if you look at the 4 different divisions, interestingly, they're pretty consistent. They actually range between 20% and 40%. Our financial advice division is actually quite profitable. We're lucky in terms of the way that we run our business, the types of clients that we work with that are willing to pay appropriate fees for the service we deliver. So the financial advice division generates about a 30 to 32% operating margin, the same as our accounting division. Our corporate advisory and capital division can be anywhere up to 40%. And our SMSF division, because it's scaling, it's only 2 years old, is around about 20%.
And your peers in the financial services / financial advice space, I mean, there's a lot of consolidation going on, a lot of acquisitions to achieve their scale and growth. Is that where you plan that to come from? Given you're also buying back shares and paying a dividend, how do you get that balance right between looking after shareholders but also maintaining growth?
Yeah, so I think we're really proud of our team that are very growth orientated. So we believe that every one of our divisions has got the ability to double in size quite easily from an organic point of view. So I think that will be the core focus, and that's what we've been looking at for the last 2 to 3 years. But you do come across really talented people that you'd like to add to the team, and they're often people, for instance, like last year, that had around about $1 million of revenue, but they were in too small a business. They wanted to join a business that had a similar philosophy, that had additional services. And so we see that playing out as well. So we see quite a few of those coming forward. So we balance it between the organic growth driving the operating cash flow, making sure we're getting the dividends in the hands of the shareholders. If our share price is below what we think is fair value, then we'll buy that back. You're constantly moving these levers around on a reasonable basis, but the goal at the end of the day is to grow the earnings of the business, and therefore you can pay more dividends, and obviously share prices improve as you increase your earnings profile.
And ultimately, do you see financial services being a high margin business?
Yeah, look, I think high margin is probably defined differently by different people, but I still think that within that professional services environment, if you can make 30% on turnover, potentially up to 35%, that's a really healthy margin. And I think the fact that a lot of clients, 80% of our clients are returning every year, allows you to keep on reinvesting in the business and making sure you've got a pretty great service. So yeah, I think that margin can continue, if not increase slightly.
Great, Simon. That's all we have time for. Nice to have you back. Have a good weekend, and we'll see you later in the year.
Thanks so much, Tim. Have a good day.